All right, everyone. Thank you very much for joining us today for another great Advanta educational webinar. Today we'll be focusing on how to structure real estate in an IRA and how to avoid paying taxes while investing in real estate. We're going to be focusing on avoiding taxes and also doing tax-free investing in real estate. So pay close attention. If you have any questions, please make sure that you do type them into the chat box, as everyone has been muted. So you will not be able to verbally ask any questions. I do encourage you to ask questions often throughout the presentation. They do typically help to enrich the presentation quite a bit, so we can make sure that you get the specifics of how these concepts and accounts can work in the real world past just what we are putting out there for our presentation today. A little bit about myself. My name is Alex Perney. I've been with Advanta here since the beginning of 2012. I'm a certified IRA services professional. You can reach me at all the contact information here presented on this slide. I do encourage you, if you have any questions afterwards, if you kind of come up with a question a little bit later on, contact me directly. I am certainly happy to address those questions on a case-by-case basis or see how something might directly work for you in the real world with your retirement account. The legal disclaimer is we all love to make sure the lawyers are satisfied. Advanta IRA and our employees, we do not provide any tax or legal or investment advice, nor do we endorse or promote any investment products. Everything that we are presenting today is for educational purposes only. We do encourage all parties to consult with their attorneys, accountants, financial advisors, and other registered professionals before entering into any type of investment. So with that out of the way, here's a little bit of the agenda we will be covering today. We're going to define what exactly a self-directed IRA is, give you a little bit of background on Advanta, who we are as a company. We're going to spend a lot of time on the different types of self-directed plans, because that has a lot to do with how you pay taxes with regards to the real estate you're investing in these plans, and how you can do it tax-free as well, because not all plans are created equal. The different types of investment options that are going to be available to you with doing self-direction, as well as some specific case studies that are going to show you mechanically how these will work, and we'll also get into how these are going to avoid taxes as opposed to doing them outside of the IRA as well. What is a self-directed IRA? IRAs in their DNA are the exact same no matter where they are. So an IRA here is no different than an IRA down the road. What is different is the company that administers it. We at Advanta have the specialized knowledge and platform to allow you to invest in things like real estate, promissory notes, private equity investments, and to do those things with the great tax benefits that go along with Roth, traditional 401k type of accounts. Whereas we don't specialize or would not do the job of a broker-dealer very well, they would not do our job very well either. So we specialize in allowing clients to take control of their retirement accounts and invest in what they know in order to gain those tax-free type of investments. A little bit about us. We have over 20 plus years of experience here in the industry. We do hold all of the cash that is held in any IRA in a very traditional banking relationship. Every single cent of cash held with us is fully FDIC insured up to the applicable limits. I do need to update the actual amount of assets that we have under management for our clients. It is approaching another milestone. Hopefully within the next year and a half, we will cross the $1 billion mark for assets managed for our, or I should say managed, assets administered for our clients. And we also have a great network of CPAs and attorneys that can help advise our clients on the best way to manage those underneath of our platform. And we also have dedicated account management. One of the most important things about the type of investing that we're talking about and real estate in general is a hands-on approach to this type of investment. And it doesn't just stop with the investment. It really starts with the administration of that account. So we offer dedicated management of each account. So every single person at Advanta has a dedicated representative that walks them through everything from the actual investment, so doing the investment, signing contracts, to actually funding it and maintaining the ability to have the tax-free investment in real estate. We find it as a very important aspect of what we do. If you have any questions, please feel free to give us a call. All of our consultations are always free. Mark, if you're having issues with the actual audio for it, feel free there. You can just use the computer audio portion of it. It should be on the left-hand side of the actual box that you have pulled up in order to just dial directly through your computer for that. So now here's where we're going to spend a good amount of time with regards to how this actually works with regard to how you're going to mitigate taxes or exempt yourself from taxes in investing in real estate. So it's important to understand and have a good solid base for exactly what you're doing, because without understanding the type of account that you're investing with, it's impossible to really maintain the type of tax deferral or exemption that you want without understanding how each of them are treated from a taxable standpoint. The most common type of plan that a lot of people associate with an IRA in general is the traditional IRA. It is the one that is by far and above the most common use of all of the different types of accounts, because it directly accepts funds without having to pay any taxes or penalties from previous employer plans like SEP IRAs and individual 401ks. So the majority of people that have had previous employer plans that have worked for someone for a very long time and maybe have shifted careers or have moved out of that particular position will elect to move those funds from the employer plan into a traditional IRA, because the good thing about it is that you don't have to pay any taxes at that time, you don't have to pay any penalties, and you can continue the tax-deferred growth of those monies and can continue to contribute to it, whereas if you no longer work for that employer, you obviously cannot then in turn participate in that plan. The traditional IRA has a very fundamental aspect of being a tax-deferred growth vessel. But when I say tax-deferred, there is a misconception that there is a different treatment of the investments between all these types of plans. One important thing to understand is that the actual investing, so the life cycle of the investment underneath of the plan, is more or less the same for every one of these types of plans. Where you get the inherent benefit of whether that you're ever going to have to pay taxes or where you're actually going to pay taxes comes from the beginning of that plan. Whether or not essentially you have taken any type of deduction for contributing money into that plan is going to determine whether or not you ever have to pay taxes coming out of that plan. The most common type of fully tax exempt investment vessel would be the Roth IRA. A lot of people are very familiar with this, or maybe they've heard people talking about a Roth IRA. One big misconception that I like to kind of dispel with these presentations is that you do not have to have a Roth IRA in order to do a self-directed investment, in order to invest in real estate with an IRA. You do not have to have a particular type of IRA. Any of the accounts that are presented to you on this slide can be used to invest in real estate. They can be used in any number of ways. You don't necessarily have to have one or the other, or one up here does not allow for a different type of asset in it than any other one. So with the traditional IRA, you have received a deduction for adding money into the plan. The money grows and grows and grows, and then when you take money out in retirement personally, so if you take money out to go on a vacation or pay for a personal expense, you pay ordinary income taxes on it. It's reported on IRS Form 1099-R, and you just pay whatever your current marginal tax rate is on those funds. With the Roth IRA, you don't get the benefit of taking a deduction for the money added in, but you do get the inherent benefit of never having to pay taxes when you distribute money out in a qualified manner. So long as that account's been open for 5 years, when you reach the age of 59 and a half, all of the profits distributed out of a Roth IRA are completely exempt from ordinary income taxes. And the other nice thing about all of these plans is you don't have to track any type of basis for capital gains. So all of these accounts are going to be exempted from any type of capital gain tax that might otherwise be applied to doing these investments personally. So that's one big thing of ways to mitigate the taxes for real estate investing and doing it in a tax-free manner is that you can get rid of having to pay any type of ordinary income tax on rental streams. You're going to get rid of any type of capital gains on the equity and the sale of the property, and that has to do with any of these types of accounts. The big difference between some of them is that when you take money out in the very end is that you might have to pay some ordinary income taxes. Now, for the real estate investor that we see a large trend of is that they typically are going to be a self-employed individual or have a few partners that they operate with in order to do these types of investing. So the amount of contributions to maybe a traditional or Roth IRA don't quite get them to where they need to go in order to start actually investing in real estate. The nice thing is that there are business plans. So most people are familiar with the 401k, which we'll get to the individual portion of in a second, are hard to really kind of get to that point where you can invest in real estate. So the nice thing is that you can utilize the small business plan, excuse me, you can utilize small business plans in order to have a self-directed account. The two types of IRAs that are going to be used for this are the simple IRA and the SEP IRA. The simple IRA is the older of the two types of plans, which allows for a portion of salary deferral into the plan and then a either profit sharing or corporate match of the contribution into that plan. The newer version of that, and keep in mind that those are deductible contributions, the other type of plan that's associated with that is the SEP IRA. The SEP IRA allows for much higher contributions than you might be able to get out of a simple IRA, up to the amount of $54,000 for the year of 2017, based on a max out salary being paid of $270,000. So if you're a high wage earner or maybe making a lot of commissions or doing a lot of service-oriented work, you might be better fit into utilizing a SEP IRA in order to maximize contributions into that plan for investing in real estate. And the taxation treatment of a SEP IRA and traditional IRA is going to be exactly the same. So the deferral aspect of that, meaning that you would be getting deductions for adding money in and then paying taxes on the way out, is where you're going to see the similarities between those two types of plans. Now, the nice high contribution limits for the 401k plan that most people are very familiar with is scaled down to the individual as well. Individuals can utilize a 401k plan if they are a sole proprietor, if they're involved in a small partnership business with owner-operated business or owner and spouse businesses, can utilize a 401k that might otherwise be rather expensive to administer. You're exempted from a lot of the different types of regulatory requirements for compliance, I shouldn't say compliance, with what's called discrimination testing to make sure participants are equally treated with the individual 401k plan. The really cool part about a 401k plan is that you have the ability to make it a Roth 401k plan, meaning that you can get fully tax-free real estate investing done in a high contribution type plan. When I say high contribution type plan, I mentioned that the SEP IRA has up to $54,000 that you can add in on an annual basis. The individual 401k is very similar in that respect, in that you can contribute up to $18,000 of your salary from the business that's established to a 401k plan, and you can contribute up to $35,000 of the profits from that business into that plan as well. And individuals over the age of 50 and a half get an extra $6,000 catch-up to their salary deferral. Now, I mentioned that you can do this as a Roth plan as well, so meaning that you are not taking deductions for the portion of your salary put in. So you have the ability with an individual K plan to add in up to $18,000 to $24,000 of Roth money into that plan a year to invest completely tax-free and then get the great benefit of getting tax-free distributions once you retire. Not as common to what we administer, but certainly a very viable option for, especially for the self-employed individual, is the ability to self-direct a health savings account and an education savings account. The taxable consideration for both of those types of plans is going to be structured almost exactly along the same lines as a traditional and SEP IRA, with some very specific differences as to what would constitute the qualifying distributions from them. Health savings accounts have their own whole set of rules and regulations with regards to what qualifies a qualifying tax-free distribution from it for a qualifying medical expense, which has its own full presentation that I do as well. But understand that the contributions to both of those types of plans being significantly less $3,350 for an individual and $6,750 for a family plan, and then education savings accounts have a $2,000 per year per beneficiary cap on the amount of contributions that you can add into those plans. So understanding where you're starting is going to really determine how much tax you ever do have to pay with investing through these types of plans, and if you ever do have to pay tax as well. So the plans that are going to allow you to fully exempt any taxes from the real estate investment would be the Roth IRA and a Roth 401k. But keep in mind that you are going to be paying taxes on the fact that you are getting no deduction for the money added into those plans, so the upfront cost to maybe add money into them and get started might be a little bit higher. So the investment options available to anyone looking to do self-direction are vast. Now, real estate certainly would be about 70% of what our clients invest in. It's really what we have, I would say, the greatest depth of knowledge in doing for our clients, but it certainly is not the limiting factor with regards to what you can do. Understanding that real estate, with its high potential profitability and the ability to create long-term cash flow, certainly lends itself very well to this, and especially when you're doing it in something like a Roth IRA, where the tax liability from a revenue stream of rental income or the equity would be completely exempt, being very attractive. Some people may not want to necessarily expose the IRA to some of the liabilities that go along with doing real estate. So we have a lot of clients that do the lending aspect of real estate that will lend either a secured mortgage, first or second, can do it unsecured, hard money, equity participation, and any number of ways to get involved with real estate. You don't necessarily have to buy it outright in the IRA. And then the added benefit to doing that in a retirement plan is that any type of ordinary income or maybe capital gain from an interest that's paid on the principal lent out would be exempt in any type of plan as well. Keep in mind that the only time that you're paying taxes on the profits from any one of these types of investments would be when you eventually distribute money out of the plan at the end of its life cycle. Now, some people like to structure things a little bit different. You can certainly do real estate in different structures in an IRA. You don't necessarily have to hold it directly in the plan if you don't want to. You can hold it under a single member LLC. You can hold it under a trust, a land trust. There's many different ways to actually hold the real estate, so don't necessarily think that you are just restricted to holding the title directly at Advanta. You can make sure that it is a good fit for you in whichever way that you would like to essentially hold that through the life cycle of the investment. We do have people that do futures trading, Forex, different types of private placement and private stock. I had several discussions with people this week that were trying to invest in companies before they had their initial public offering. So there is a lot of different flexibility with these types of plans to take what you know and understand and create a tax-free or certainly a very good tax-deferred amount of revenue or profit for yourself and essentially secure your retirement with what you know and understand. Now, it may seem a little bit cliche, but I like to kind of hammer home the fact that when you go to find a deal, now most people say, well, since you don't provide any investments, how do I figure out what I'm going to do with Advanta? Because most people are so used to just going to a brokerage and kind of doing research and picking stocks. Well, you get to not only invest in what you know, but with who you know with an Advanta account. You get to use the network of people that you've been maybe doing real estate deals with or that you have known for many years in order to make a investment that makes sense for you, makes sense for your retirement, and is something that you can have a much greater control over than just kind of picking companies off of a random stock sheet. So again, although it may sound cliche, I do like to kind of hammer it home. Using self-direction, let's invest in what you know, but also with who you know. So if you take something away from it, my little saying might not be a bad one. Now, when it comes to actually structuring the real estate in an IRA, this is going to go for any of the different types of plans that we discussed with the exception of a few minor differences with a 401k, which we won't get into in this presentation. But understand that the important aspect of making sure that you do get the great tax benefits of utilizing a self-directed IRA or other type of retirement plan starts in the beginning, making sure that the IRA has a valid and enforceable claim on the investment is the ultimate end goal of what we are doing and the service that we're providing to your IRA. Now, how do we make sure that's done? Going back to the beginning when we talk about the dedicated account management that we offer, that's really where it starts. That we start with making sure that when you initially identify a property that you're interested in purchasing, that we get that contract right, that we make sure that it's correctly titled in the name of your IRA. The naming of the IRA on a contract or deed or any type of other real estate related closing material would need to be named in the name of Advanta IRA for benefit of the client name and the account. Now, we have a little bit of flexibility if people would prefer to remove their name from public record or their account number, but essentially that's what you're looking at. We also need to make sure that we are signing everything. One of the most common things that I see that kind of throws a wrench in the ability to make these great tax-exempt profits is the fact that it's not started with a good foundation. If we start everything correctly and move through the process, it goes very smoothly, and we can make sure these deals close on time with little to no additional effort on behalf of you as the client. Now, keep in mind that all of the funds have to come directly from the IRA. So it's something that if your IRA is going to be purchasing the piece of real estate directly, all of the funds are coming directly from the IRA. And keep in mind that you do have to have a bit of a crystal ball in that aspect. If you do have something that inherently needs to be done, maybe the roof has another 3 years of life left in it, and places like Florida where we've seen large storms come through and maybe has a little bit more of a wear and tear aspect on the roof, you're going to have to pay for that out of the IRA. So are you cash flowing on that property? Is the property something that you're going to turn around and flip? Are you going to put in the effort to rehab the property? All of those types of expenses have to come out of the IRA. Now, making sure that you have enough of a foresight to look and see that, make sure that is done, is something that essentially we can kind of try to walk through it with you and show you how it would work and how those expenses are paid out. And keep in mind that all of the income, every cent of it, is what's going back into the IRA, which can be used for those repairs as well. But now, keep in mind that the rental income is not going to be subject to any ordinary income tax. It's not going to be subject to any capital gains when you sell the property. So all of these things are coming back, and that does not matter what type of account it is, completely tax-free. The life cycle of these accounts, remember, is relatively the same with regards to the types of taxes that you would otherwise be subject to. And one thing I do like to point out, and you're going to see this enumerated when we get into the case studies, is that the amount of money that the client is able to reinvest and the rate at which they are able to do it is much greater in one of these types of plans. Whereas an individual might have to escrow out 20 to 30% of their profits or maybe their operating income for a real estate investment just to make sure they can cover any potential personal taxable liability. The IRA, if it goes out and invests, can take every single cent that it gets back at closing and reinvest it into a new property without having to worry about waiting till the end of a taxable year to reinvest, with making sure that taxes are correctly paid and paid timely. Things can get done quicker, growth can happen quicker, and the ultimate road to where you're trying to get to can be moved down at a greater pace than otherwise may be able to be done outside of the IRA. Now, notice we haven't had many questions so far. We are going to be getting into the case studies here. I do want to encourage people, ask questions. You know, we're here to help you. If you do have any specific questions regarding a certain investment, maybe put it in the chat box. I'm certainly happy to review a specific structure maybe that you have that you'd like to get some clarification on. But other than that, let's move in to the case studies. So purchasing real estate is certainly one of the most popular. I would say about 70% of our clients directly invest in real estate with their IRAs. Now, the real estate is going to be invested in one of two ways, either lending to someone for them to actually purchase the property or to buy it directly outright. So for this case study, 123 Main Street, John Smith identifies a property being sold at short sale. He puts in an offer with his IRA, and the offer is accepted at $120,000. So as we covered on the previous slide, Advanta IRA, FBO, John Smith, and his account number is going to be titled on the contract. We're going to be signing that contract. We're going to issue the escrow deposit and then also work towards closing with that as well. And then all of the funds for this deal, all $120,000, are going to come directly from the IRA. Now, with that said, the property is going to be rented for 2 years at $1,200 a month. He sells the property in 2 years for $170,000. So he has $50,000 of upside profit that is going to be completely exempt from any taxes. Along with the rental income, he now has another $78,800 of profit, along with the $120,000 of basis that he got back as well, to reinvest. So in 2 years, he goes from $120,000 to $198,000 without having to pay a cent of taxes in the IRA, and then gets to get into bigger deals that maybe have a better profit, maybe not, but can certainly get into more expensive deals quicker than you otherwise would outside of the IRA. Great. We got some questions rolling in. Fantastic. All right. When it's time to start taking required minimum distributions, what happens if there's just a property in the IRA but not much cash? Great question. So with traditional IRAs, if you have a traditional IRA that's invested in real estate or a 401k, you're subjected to what's called a required minimum distribution. Because remember, with a traditional IRA, you've gotten a deduction when you've added money in there. Everything's growing tax deferred. So the IRS has not realized any income from that account. So they say when you get to a certain age, they're going to require you to start taking out a portion of that account on an annual basis. It's based on life expectancy tables that they publish and whether or not you are married, and also factors in the actual value of the account to determine how much you have to take. So if you're invested in something that's highly illiquid, like a piece of real estate, and you don't have enough cash in that account to cover that required minimum distribution, what do? Well, remember that it is calculated on all of your retirement accounts. So if you have another account somewhere else that has enough cash to cover it for all of your accounts, one IRA can satisfy all of your IRAs with a distribution. But let's say you don't. You can actually take an in-kind distribution of a portion or all of that property as well to satisfy that liability. I've seen clients that have actually distributed, let's say, a quarter of the actual asset to themselves personally. So then they own maybe 75% in the IRA and 25% outside of the IRA, and then split all of the income expenses accordingly. Another interesting strategy to avoid this is that when you are reaching closer towards the actual time when you're going to have to start taking required minimum distributions, maybe look into actually doing Roth conversions, because with a Roth IRA, you have no required minimum distributions. So if you can either have started with a Roth or get everything into a Roth before you reach the age of 70 and a half, you can avoid having to take required minimum distributions altogether. So what you would do is get an appraisal of the property and then either convert the entire amount and pay taxes on the value, or do portions up until that time as well. And you can even do it closer to the end of the year, so you can do Roth conversions and split the liability over 2 years within the span of about a week. We do whole presentations on Roth conversion strategies and when may or may not be a good time for people. I'd encourage you to get on our YouTube channel or our Learning Center to look at that as well. Okay, Mark has a good question. If you underestimate the funds required, can you supplement the Advanta account with additional transfers from an existing IRA? The answer is absolutely. You can always put more money into an IRA from another IRA. There is no limit to the amount of money you can transfer between IRA accounts. There's also no limit on the amount of money that you can directly roll over from a previous employer's plan as well. So if you had, let's say in this case, if John had purchased this property for $120,000 and he only had $130 in the account and it needed, let's say, $30,000 worth of work that was unexpected, if he had that money in another IRA or another 401k, he could move that to cover that expense. Because remember, all expenses related to the actual asset in the account have to be paid from the account as well. So you can certainly move funds over, or if you had maybe a tax bill and you just wanted to make a contribution, if you're eligible to do so, you could also do that. Okay. Got some great questions rolling in here. Let's just get through the rest of these. Anthony asks, can a portion of the profit be directed to the individual for ordinary living expenses? I realize that there would be tax on this amount. Certainly. You can always access the cash in an IRA at any time. You just have to understand that certain accounts might have either a tax or a penalty associated with that distribution. So if you are investing in something, and let's say in this case, John wants to distribute $200 of the $1,000 a month rent check. $200 would be taxable to John, and then the $1,000 would be completely exempt. The rent check would get deposited by Advanta, and then we would distribute a portion of it once it cleared directly to the client. For the profit on a sale, it makes no difference. You could certainly distribute a portion of sale or the income from a property. It really makes no difference. And can funds be moved from a 457? Absolutely. A governmental 457 is a qualified retirement plan to be directly ported without tax or penalty if you are no longer in public service directly to a traditional IRA with no taxes or penalties. Great questions. Keep them coming. I would encourage you to get them in there because we can certainly address questions regarding structures, taxation, different types of plans. So great questions. Thank you very much. Now, many people don't necessarily have enough money to invest in real estate, or maybe some people don't want to invest in real estate for other different reasons. The liability associated with investing in real estate extends to the IRA. So I always tell people, they ask, how can I best mitigate that liability? I tell people, get good insurance and make sure that you are properly covered. Everything that you would do outside of an IRA to help protect yourself in that type of investment, I would encourage you to do the exact same thing inside of an IRA, because you can insure an IRA-owned property just like you can one outside of the IRA. So making sure that you do that correctly is very good practice. Now, some people just want to avoid that altogether. Well, one way to certainly help reduce that exposure is to lend someone the money out of your IRA, to purchase a piece of real estate. So just like you would maybe go somewhere and get a loan from someone to buy real estate out of the IRA, your IRA can act as the bank. So instead of looking at a note and mortgage when you buy a piece of real estate and seeing ABC Bank NA, your IRA, so Advanta IRA, FBO John Smith IRA, would be the lender on a mortgage. Your IRA would be named on the note as the lender. It would be named as the grantor on the mortgage. And if the individual failed to pay, then you would just go through the foreclosure process in the IRA in order to take that real estate in as satisfaction for the loan. Now, the nice thing about this is that you essentially get to choose your rate of return. You have some potential to reduce the exposure to market fluctuations in price because you are lending someone money with a guarantee that it will be repaid at a certain rate of return, the interest rate. And all of that interest that's paid back is going to be completely exempt from ordinary income. If there is any type of profit sharing that is associated with the note, then you're also going to be exempt from capital gains short or long term with that as well. Now, you don't have to do a mortgage. Obviously, that is going to be certainly something that is considerably more secure and offers a little bit more guarantee of repayment in certain aspects than other types of loans, but you can do unsecured loans as well. A common term being hard money loans for the real estate market, where maybe you know someone that does a lot of rehabs. So you know someone outside of the IRA that does fix and flips or invests in different types of properties, and they need short-term funding to get those things done. You could lend them out of the IRA an unsecured loan, typically at a much higher interest rate than you would see on a mortgage. Now, the unsecured loan, just as the name implies, does not have any recorded security that in the event of default you would be able to foreclose on with the IRA. So doing extra research and extra due diligence in that type of scenario would certainly be something that would be very much best practices. And keep in mind that if you're doing something like that in a Roth, or if you're doing it in a Roth 401k, no taxes are ever going to be paid when you take money out of it. So any of the appreciable gain of the interest being charged, you're never going to have to pay taxes on those types of accounts. And even if you had it in a traditional IRA, you're not going to be paying income taxes on that as well. So we have another question. Can I invest in metals such as silver? The answer is yes. We don't necessarily do a lot of that type of investing for our clients, but you can invest in any type of IRA qualifying metal. Those metals are gold, platinum, silver, and palladium, so long as they meet certain fineness requirements. I tell people most of the time, if you are buying from a reputable dealer and buying proof coins from a large government such as the American Eagle series, the Canadian Maple Leaf series, the Mexican gold and refined peso series, those are typically going to make that fineness requirement, and you can certainly hold those in an IRA. Okay, can you make any transfers of funds into your self-directed IRA from non-401k or IRA money, Beverly asks. For instance, can you put in $2,000 to shore up the account? The answer is yes and potentially no. So each one of the accounts, when we went through that slide, has an annual contribution limit, meaning what you can take out of your own personal pocket of what you've earned in a given year and contribute into that account. Now, the main requirement for a traditional or a Roth IRA is that you have earned income, meaning that you have claimed it on Schedule C of your 1040 personal tax return, that it is earned income. Now, with a Roth IRA, you might have a restriction on being able to directly contribute money into that account if you make too much personally, which would be $192,000 for married filing jointly, and I am blanking on what it is if you are a single filer. But even if you did make too much, you can always contribute that money to a traditional and then convert it. But more to the point, if you need to put in money in order to, let's say, pay a bill or something like that, if you have not contributed for that year and you need to add in a few $1,000 up until the $5,500 or $6,500 limit of your age, certainly that's not a problem. And that would always come from your personal monies, not from other IRAs or 401ks, because remember, 401ks and IRA transfers are unlimited in amount and unlimited in number that you can do per year. Now, the unsecured note and the mortgage are very common, but you can certainly get a little bit more exotic as well, something like where you would maybe have two loans where one pays the other, and then there is a difference for the potential for profit, typically referred to as a wrap loan, or something that I personally find pretty interesting is the equity participation note, where maybe instead of a given interest rate or a given repayment schedule, there is a clause for participation in a portion of the profits. And we will do a case study on that. So here's how essentially a mortgage loan would work underneath of an IRA. Sam has a network of investors in Florida. The Roth IRA acts as the lender to the investor and the flippers, and all of the loans are secured by a first mortgage. Now, it's kind of interesting. One of the bigger accounts that we administer is someone that does strictly lending. So the potential for the large amounts of money to be made in this is certainly there. It's just a matter of doing what you understand and know in order to capture those types of tax-deferred or tax-exempt gains. All interest and payoffs are non-taxable, and all personal distributions in this case, because it's in a Roth, are completely tax-free. Okay, Anthony, great question. Can I transfer a property I already own into an IRA? If that property is already personally owned, then no. Essentially, there is potential if right up until that you have purchased a property to potentially unwind things and then pursue that purchase in an IRA. But if you have sent the money to closing and you have closed on that property personally, you cannot make a contribution or transfer a property owned personally into an IRA. And it kind of brings up an interesting point, is that any contribution, such as in the previous question, up to the $6,500 or $5,500 for IRAs, those always have to be made in cash. You cannot make it as an in-kind contribution of property or tangible assets into an IRA plan. So if you ever want to make a contribution, just remember it has to be in US dollars and in cash. It cannot be a cash equivalent or other type of valued asset. So Mortgages. Everyone understands them. Everyone, for the most part, probably has a personal experience with one for their personally owned property. Now, what I said I thought was really interesting is that we do see kind of a change in the marketplace with regards to how some people are investing in loans. With the reduction in inventory and potential increase in prices, the people that are actually doing the rehabs are obviously having to pay more money for the property they're purchasing. So their ability to maybe make a scheduled payment or to pay a payment that is going to be commensurate with a interest rate on that might be reduced. So how do you make something work in that scenario? And how do you make this work correctly in an IRA or make sure that both parties are getting a good deal? And what we've seen is that people, instead of maybe getting a stated interest rate or having to make direct payments, are saying, hey, I will lend you out of my IRA a certain amount of money, and then instead of getting a fixed interest rate, they will say, and 30% of the profits. So in this case, Jane and Andy know a contractor that flips properties. They lend 50-50 from each account to do the rehab to the rehabber. Now, in this case, each IRA, so Advanta IRA, FBO, Jane Smith, and Advanta IRA, FBO, Andy Phillips, are going to be 50-50 partners as tenants in common lender on that note. Now, when everything is paid back, that 30% of the profits at sale is split between each of their IRAs, and they're paying no capital gains. They're not paying any other type of appreciable ordinary income tax if there were to be a direct payment, and it's going directly back into the IRA once that property sells, and it's being split 15 into each. You can certainly make something else that works for that particular situation, and the ability to mitigate those taxes is really the big impetus for people doing the lending, where they get a portion of the profits on a loan, as well as making it a good deal for everyone involved. Okay, so case study number 3. Rachel has $150,000 in a Roth IRA. She buys foreclosures the property for the day of for $100,000. The IRA pays for the rehab costs totaling $30,000. So the IRA is into it for $130,000. The IRA sells the property for $210,000. Now, that entirety of that profit, being $80,000 in this case, would go directly back into the IRA. There's going to be no capital gains paid on that. There's going to be no ordinary income if she were to actually rent out the property for any reason. And the IRA, as we kind of reviewed earlier, is going to be able to get into bigger deals and do them quicker. One of the big constants for real estate is that it's a relatively fast-moving and dynamic marketplace. So the ability for you to get away from having to pay taxes on an annual basis or pay taxes ever for these types of investments if it's done in a Roth IRA or Roth 401k really kind of shows in this slide as to how that can really benefit you. Because not only are you just saying, hey, I'm not having to pay taxes personally, the ability for the investment vessel to grow much quicker is one of the biggest benefits to not paying taxes when investing in real estate in this matter. Now, a lot of people in different areas have different types of property, and one of the more interesting structures that I've seen with Advanta is individuals that invest in manufactured homes. In Florida, we have a large, very large population of retirees, and the price point of a manufactured home is certainly attractive to people that live on fixed income. Also, in more rural areas, it's a little bit easier to get in manufactured homes because of the ability to move them to a little bit more remote areas and not having to build. Jim, in this case, uses his SEP IRA, so a simplified employer pension, the one that we talked about. You can add up to $54,000 into on an annual basis based on your compensation of the business is established for. He takes that SEP and invests in a manufactured home community. He directs Advanta to buy a 30-lot manufactured home community for $110,000 in the state of Georgia. He creates revenue from installment contracts on the trailers and from the lot rent charged on the trailers as well. So the trailers are sold to the individual, and principal and interest is paid back, and they are just as it would be in a mortgage, and then rent is charged for the trailer sitting on the lot in the park. The continued revenue stream of this is collected by the SEP, and no taxes are paid. Eventually, that's all going to compound within that IRA and create a lot more money and completely exempt the individual from having to pay any taxes on that type of investment. So who signs the actual purchase contract, Jim or Advanta? In this case, Advanta, as the authorized signatory on the IRA, signs everything for the IRA. In some instances where people utilize maybe a trust or an LLC, the manager of that trust or the LLC, whomever that may be, would be signing contracts. But in this case study, the actual purchase contract, the settlement statements, and any other types of prorations or other closing documents are all going to be signed by Advanta as the authorized signatory of the account. Now, that does pretty much bring us to the end of the presentation today. I would encourage everyone, if you do have any questions, please ask them now. I will stick around. Can I do work on my own investment property? If it's in the IRA, no. So you essentially are prohibited from doing any of your own sweat equity in the property. You can certainly solicit anyone that you would like to do the property, so long as that they are not a direct lineal descendant or ascendant of you personally. So making sure that you're just essentially not related to them. You could potentially use a brother or a sister to do the work, but you yourself could not actually roll a paintbrush or swing a hammer with regards to the maintenance of the actual property. We do see a lot of people that utilize third-party property managers, and we're fine with that. You could have a company manage the property and have them collect the rents and then distribute it back into the IRA on a scheduled basis, typically covered under a management agreement. But unfortunately, you could not do the work yourself. Deborah, if you have questions about fees, give me a call after this. It's not as easy as kind of just giving you a flat rate. It really kind of depends on what you're investing in, and we have some different options to help you get on the most streamlined fee schedule as possible. Okay, got several questions coming in. Are there any SLAs associated with how quickly Advanta moves in regards to getting documents ready for deals? Yes. So if you get us a contract properly titled in the name of your IRA that you have initialed and scanned over to us, we typically get that back within a few hours. Our policy and procedure for getting property closed is that within 48 hours of documents received in good order, funds are released to that. Obviously, we understand it's a very dynamic marketplace. Just so long as that we have good communication with our client and we have documents in good order, we can always work within relatively tight time frames. But the biggest thing I would tell anyone is in doing self-direction, make sure that you communicate with us. You have a dedicated account manager that's always assigned to you. Give them a call, shoot them an email, let them know what's going on with your actual account and what you're looking to do, and we can help make sure that it's done in a very timely manner. Okay, Beverly asks, so you must have a property manager if you have a rental property in the IRA? No, you can certainly have anyone do the work you'd like. You can, if you have been notified of something happening to the property, you can, make sure that the work is done correctly. You just can't do the work yourself. You can make sure the work's done correctly by any third party, but essentially you just cannot do it yourself. But you don't have to have a formalized property manager. You can use handymen. You can use whomever you'd like. Again, just making sure that they are not your mother, father, son, daughter, or your spouse. Okay, with a SEP IRA, can I transfer current investments into the IRA? If they are personally owned, you cannot transfer them, you cannot move them into an IRA. But if they are current assets in a current IRA, you can transfer a traditional IRA into a SEP. We just have to make sure that those assets are currently owned by an IRA in order to transfer them into an IRA. The big key factor there is making sure that any asset that is owned by an IRA can be transferred to another one, but you cannot transfer a personally owned asset into an IRA. Okay, how is the annual value of real estate investments determined in connection with annual reporting to the IRS? So the big thing that we have to do is make sure that the annual values are correctly reported to the IRS. We require on an annual basis the client to confirm the fair market value of the property. You can do that via a comparative market analysis. We are okay if you want to utilize the tax assessor's fair market value if they provide one, but essentially until you actually have to take a taxable liability out of the account, so you either reach the age of 70 and a half or you want to do a Roth conversion or distribution, we do not require certified appraisals to be done. Deborah asks, if the home is purchased in an LLC by a son, can the property be maintained by the father? I would hesitate to say no. I would need to see a little bit more detail about that, but if the IRA is owned by, if it is the son's IRA and the IRA purchases the property through an LLC, it could not be worked on by the son's father. Okay, great questions. Keep them coming in. The title company does the actual closing with the document sent to Advanta. Correct. So Advanta, essentially, the IRA is the actual purchaser on the property. So we send closing instructions to the actual title agent. We work with them directly to make sure everything's properly titled. We send everything to you in one packet for your approval because we do not send any type of money out of your account without direct consent from you directly. So we send you a package to mark as read and approved. Then once we have all the documents, so settlement statements, copy of the deed, copy of the signed title policy or title commitment in our possession, we will then issue funds. And again, standard policy is within 48 hours, but we can certainly work within augmented time frame so long as that everything is in good order. Peter, great question. I can certainly answer that in greater detail. It's a question that could probably have its own presentation in and of itself. If you did put your email on there, I can go through that. But essentially, it falls down to the stated custodial agreement and where the actual administrator is chartered. We can go through that. Just give me a call and I can certainly go through that with you. But how to research the strength of an administrator, it's hard to say. I mean, talk to our clients, look at ones that have been around for a long time. Longevity in the industry is certainly a good indicator of best business practices. We maintain AAA rating with the Better Business Bureaus here in Florida and in Georgia, where our two offices are located. So with typical research, I would say, is probably a good course of action for researching the strength of an administrator. Mark asks, so can I lease and collect rents myself from a self-directed IRA investment? You can certainly qualify your tenants. You can have them mail a check made payable to your IRA to you to make sure they're paying on time, but you couldn't necessarily have them make the check payable to yourself personally and then write a check to the IRA. So where I like to say you can't act as a property manager, you can act as a rental coordinator. You can make sure that the tenant is paying on time. You can have them mail you the check made payable to Advanta and then forward it to us. You can make sure that you are qualifying them. You can require background checks. You can really do whatever you would like to, underneath the letter of the law to make sure that you are getting a good tenant in the property, but you could not necessarily act as the full property manager or, directly collect the rent by having them make it made payable to you. But we would sign the lease if the property is held directly under the IRA. Yes, you can buy properties anywhere in the United States and anywhere in the world. We have clients that have bought properties in their IRAs and everywhere from Costa Rica to Colombia, Canada, I believe there's some in Europe as well. It doesn't matter where the property is, so long as that we can get documentation properly titled and the applicable laws allow for the type of investment you're doing. It doesn't matter if it's any of the 50 states or other countries. We can typically make it work. Great question. Deborah asked, if the IRA owns 75% of the house, can the maintenance be done by the husband through the 25%? No. If the IRA is involved in even 1% or a fraction of a percent of a deal, the rules applying to whom can and cannot work, so the disqualified individual rules do fully apply in that instance. And that pretty much brings us up to the hour. Again, very much appreciated everyone that attended today. Thank you very much for the fantastic question and answer period that we have. It was certainly one of the better ones. My contact information is on the slide in front of you, 727-754-9954, and A. Perney at Advanta IRA. The G is a typo, so AdvantaIRA.com. Give me a call, shoot me an email. I'm happy to answer your questions on a case-by-case basis, or if you have anything you took away you want some more clarification from, give me a call, give Advanta a call. We're happy to help, and have a wonderful weekend. Thanks for joining.